Welcome back to Am I Catching a Falling Knife, the podcast where we break down those stocks that have taken a tumble and help you decide if it's a buying opportunity or a dangerous trap. I'm your host, Dave, and today we're putting a very interesting company under the microscope, Align Technology, ticker ALGN. This stock has been on a wild ride, plummeting a whopping 32.90% over just the last 10 days. Is it a broken company, or is this a chance to pick up a high-quality business on the cheap? Let's find out. So, what's behind this steep decline? The single most dominant narrative driving ALGN's price action is the disappointing Q2 2025 earnings and a very cautious Q3 outlook. This wasn't just a minor stumble, it was exacerbated by some serious macroeconomic headwinds, increasing competitive pressures, and news of planned internal restructuring. All these factors combined led to that significant stock plunge and, unsurprisingly, a wave of analyst downgrades. So, before we dig into the numbers, what exactly is Align Technology? Well, they're the folks behind Invisalign, the clear aligner system that's revolutionized orthodontics. Their business primarily operates in two segments. The clear aligner segment, which, as you might guess, includes Invisalign, making up a dominant 80.8% of their revenue. The other segment is Systems and Services, which covers their iTero intraoral scanners and exocad CAD/CAM software for digital dentistry. Essentially, they're all about correcting malocclusion using clear, removable appliances and digital solutions for everything from treatment planning to practice management. Now, let's get into the nuts and bolts of how this narrative impacts the company's financial picture, specifically their earnings. The market is clearly signaling a significant negative impact on the upcoming quarterly earnings. Based on that cautious outlook and those ongoing macroeconomic headwinds, we're estimating a roughly 6% decline in total revenue for the upcoming quarter. This isn't just hitting one part of their business. It's expected to impact both their clear aligner segment and their scanners and services, as both are susceptible to broader economic pressures. To put that into perspective, Align Technology's latest annual revenue was $4 billion. If we assume quarterly revenue is roughly a quarter of that, around $1 billion, then a 6% decline represents a reduction of about $60 million in quarterly revenue. Now, here's where it gets interesting because of their gross margins. Align Technology boasts a pretty healthy TTM gross margin of nearly 70%, specifically 69.87%. So, that $60 million revenue hit translates directly to a reduction of approximately $41.92 million in gross profit. And due to what we call operating leverage, meaning a good chunk of their operating expenses are relatively fixed, this gross profit reduction has a magnified impact on their operating income. We're looking at a potential 21% reduction in operating income just from the revenue decline alone. But wait, there's more. The planned restructuring that was mentioned? That's going to introduce some one-time charges in the upcoming quarter. We're estimating these restructuring costs to be around 3% of the prior quarter's revenue, which works out to about $30 million. This amount will directly reduce their operating income even further. So, when you combine all these factors, the revenue decline, the magnified impact on operating income due to leverage, and those restructuring costs, we're looking at an estimated total decline in quarterly earnings of approximately 36%. Now, I need to be upfront with you. This is an estimate, and there's a moderate degree of uncertainty here. The exact impact of the cautious outlook or how fixed their operating expenses truly are can shift. But based on the information we have, a 36 hit is our best guess. So, with all that in mind, how do we value a company like this when it's facing such headwinds? To figure out what this stock is really worth, I'm looking at it from two angles, using data I pulled from finviz.com. First, a discounted cash flow, or DCF model. For this, I'm using some key assumptions. A growth rate of about 8.1%, that's the EPS growth next 5 years estimate, a discount rate of 9.5%, and a terminal growth rate of 2.5%. Based on a base case scenario, this DCF model gives us a value of around $109.91 per share. However, when we apply the significant earnings impact from our narrative, that estimated 36% decline, the DCF value drops considerably, down to about $56.05 per share. The second method is a bit simpler, a PEG-based valuation. PEG stands for price earnings to growth, and it gives you a quick look at a stock's valuation relative to its earnings growth. Using this method, the PEG-based fair value comes in at approximately $71.96. So, considering the current price of around $129.01 and our valuations of $56.05 and $71.96, it's clear the market is still processing this news. This brings us to the big question for a falling knife like ALGN. At what point do you consider catching it? Given our analysis, I've got a few custom buy levels that might make sense. The first at $110, which aligns closely with our base case DCF. Then, if the slide continues, $70, which is close to that PEG-based fair value. And if things get even more challenging, $60, which is near our narrative-adjusted DCF value. These are points where the risk-reward might start to look more appealing, given the current headwinds. So, to wrap up our deep dive into ALGN, Align Technology, remember though, this is not financial advice. All of this information is for educational and entertainment purposes only. You absolutely must do your own research, consult with your financial advisor, and understand your own risk tolerance before making any investment decisions. Markets are complex and predicting future performance is always uncertain. Thanks for tuning in to Am I Catching a Falling Knife? I'm Dave, and I'll catch you next time.